Hello, and welcome to the AGH Wealth Management 2024 Midyear Outlook webinar. We appreciate you taking time out of your busy day and the opportunity to share our thoughts and those of our independent broker-dealer, LPL Financial, on the outlook for this year. My name is Brad Bechtel, and I'm president of AGH Wealth Management. Every 6 months, our firm provides our insights and outlook on the economy and the market for the year ahead. The slides you're about to see today are available to you in a full-color booklet, which we'll gladly provide upon request. The title of today's presentation is Still Waiting for the Turn, referring to the rate cuts from the Federal Reserve. I believe this presentation is very timely, as the Federal Reserve Chair, Jay Powell, was recently quoted this past week after meeting with other Fed members that, quote, "The time has come for policy to adjust." He went on to say the direct travel is clear and the timing and pace of rate cuts will depend on incoming data and the evolving outlook and the balance of risk. So again, I believe you'll find this information today very timely and helpful. My partner in today's presentation is Brian Gensch. He's a certified financial planner and the senior vice president here at AGH Wealth Management. His focus is on overseeing our firm's personal investment portfolios and strategies, as well as our comprehensive financial planning services. If you have any questions, please feel free to call us, and we'll be happy to address those after the presentation. Without further ado, I'm going to turn the mic over to Brian.
Great, thanks, Brad. And again, I just want to thank everybody for joining us today and letting us share our perspective and our research team at LPL's perspective. The slide deck was put out a few months ago by LPL, so a few things have changed since then. And we like to typically do our mid-year outlook in August. I think, again, like Brad said, it's timely given the Fed potential turn here next month. So the slides may not have the full data, but we'll discuss with updated economic and market information. And if there's any data point that you'd like more clarity on, like Brad said, please feel free to email or call us afterwards. We'd be happy to continue the discussion. So as usual, we'll take you through kind of 3 areas: the economic landscape, the stock market, and then the bond market environment in today's presentation. And then with really every other year, so when there's a midterm election or a presidential election, we like to provide a little bit of a perspective on the political noise that tends to surround the markets around this time of year. So we'll talk about that too. But first, to the economy. So, the first half of 2024 really featured surprising resilience in economic growth, which combined itself with some sticky but still decelerating inflation. We don't expect the resilience to necessarily last as long, but rather we expect an economic slowdown in the latter part of this year. And the slowdown doesn't mean a recession; it just means continuing slowdown in our growth. There have already been a few signs of this. Data shows spending is slowing at lower income levels, and the labor market is beginning to soften. The Fed will start their rate cuts once the data is convincing, and we believe like Brad said, they just stated that it is. And the labor market softening and inflation's contained. So this all should happen really soon, and so market reaction to that plus the elections will be an interesting thing to observe. There's been a lot of, from an economic standpoint, there's been a lot of macro distortions experienced from the pandemic, and we hate to keep going backwards in talking about the pandemic, but unfortunately, we're still seeing effects of the pandemic and the post-pandemic responses. And what's happened over the last few years is these distortions that have happened. It's created some confusion and what we would almost even say false narratives about what's going on in the economy. We first came through the narrative, at the beginning of the pandemic, that we we're going to go into an economic depression due to the pandemic. Stay-at-home orders, shutting down the economy, global supply chains completely disrupted. And the narrative at the time was this is going to lead us into the worst economic depression that we've experienced as a country. Well, that didn't pan out. And then the government threw an unprecedented amount of money at the economy, and the narrative shifted to, well, we'll just have some inflation, but it's going to be transitory, so we can shove all this money out to the economy, and that didn't pan out. And then the narrative really shifted again to this, hyper 1970s unstoppable inflation due to what the Fed was doing to interest rates. And again, that really didn't pan out. That turned a lot faster than initially the fear was it would turn. And then it was, well, the Fed's going to push us then into a massive recession not because of the pandemic now, but because of the rate hiking cycle that we just went through and that tightening policy. And then, when inflation peaked and we didn't hit a massive recession, our narrative has been that now really the new narrative is we're headed for this smooth, soft landing. And this narrative hasn't fully played out yet. And that, I think, is probably the biggest takeaway still today from an economic standpoint is we have not hit a soft landing yet. And so, we've had all these confusing, distorted predictions and narratives over the last few years. And so I think our message today is to be cautious as you move forward with whatever narrative is being given by the media, by people who sit in our chairs, by yourselves and your peers. Because a lot of times we tend to swing that pendulum all the way to each side, and they never really are the full story of what's going on or what will happen. So LPL's current view is that we are in a late cycle in the economy, meaning we should see a metric slowdown in the GDP, and that should take effect following suit with the Fed beginning to cut rates next month. Bottom line, the late cycle is becoming more and more important now to the markets. And just a couple slides on seeing some of those distortions play out. One of the distortions was the dichotomy of the split wealth effect. We talked a lot about that in past webinars on what happened through the pandemic with the wealth effect. But that's really the effect is one reason the Fed, their aggressive rate hiking campaign really didn't materially impact consumer spending as that fear was at the time. And if you look at this, you can see between extracting equity from homes and refinancing at lower rates, we saw a massive amount of cash pushed into the economy that allowed the wealthier consumer to continue to spend through the hyperinflationary environment. And so this wealth split that happened where the people with no wealth were really hitting hard times, but people with wealth were able to actually tap into that and be able to really divert themselves from the true effect of a lot of this rate hike cycle that we got. And we probably owe some of that reason to the 08 financial crisis. In when you look at household balance sheets and household net worth and household debt, really from 2008 through 2019, you saw a continual healing of balance sheets, and so that really became something that was able to be tappable in this most recent issue that we had with the pandemic. And again, so in effect, we just became less sensitive to rate interest increases, which was a big challenge for the Fed. And today, there's a growing percentage of households that have no mortgage or have very low fixed rate mortgages. Further, many households have minimal need to tap credit markets to fund activity, and if they do, they have time to defer payments. Another challenge for the Fed is the number of firms available to provide in-house financing and provide consumers or customers with a below market rate because these firms are so large they can kind of skirt some of the normal funding markets. And so this optionality that has existed now really created a lower sensitivity by the consumer on these rate hike cycles made by the Fed. And for many homeowners, the years immediately following the global pandemic were wonderful times to refinance, and many did. The large magnitude of refinancing activity created a really kind of a boon for homeowners. And now mortgage debt service is extremely low, given a boost to the discretionary income. And because of hybrid work and previously low mortgage rates, homeowners have really more money in their pockets to spend than the years immediately preceding before the pandemic. And you could probably say the same is said for a split in the corporate world, with the large companies and small, maybe mom and pop shops. Large companies with really good balance sheets, they were able to probably lock in very low rates, and right now people are making 5% in cash. Smaller businesses haven't had that same effect, and so most likely this cycle has gotten elongated because of that. But it doesn't necessarily create a high confidence that we're just headed straight for a soft landing. So we remain cautious in that tone. Labor costs really play a key role for the Fed, and it's because they really play a key role for inflation, and specifically services inflation, which has really been the stickiest part of the dynamic of pricing issues that we've had. And we're just starting to see labor markets loosen, which would pull off some of that pressure on wages and salaries. And a cooling labor market will be a good sign for easing services inflation. And that's, again, that's a big piece of the inflation number the Fed looks at. Taking pressure off of wages and salary will assist in allowing employment to stay stable and margins for businesses to remain strong, which is allowing for healthier softening of the labor markets throughout the rest of this year. And again, this is a big focus in the Fed. This week we have their most appropriate or looked at inflation measure, the PCE number, will come out this week. So that if the data on that looks similar to the narrative they gave us on Friday, I think we continue to have high confidence that we're headed for the beginning of the rate cutting cycle next month. We expect rental prices to ease later this year after they've probably been some of the most sticky, annoying, sticky inflationary numbers has been the rental prices. It's something, again, the Fed has been very keen on in looking at for their policy. But as demand cools, supply chains remain unclogged, inflation pressures are continuing to ease throughout this year. All those are showing good signs. First half of the year has been one where goods prices moderated. So if you take inflation and you separate it into two main components, we have goods inflation and services inflation. And goods really started to have that almost deflationary in some months effect on our inflation number. Services have been the one that remains strong, and that's now is the one that's been showing signs of turning a corner, which I believe was the reason why Jay Powell and the Fed was so blatant with their communication to us on Friday that things are moving in the right direction, getting ready for rate cuts.
Brian, I suppose that a lot of the stickiness on the service inflation is just, again, it was the sort of post-pandemic, the breakout, everybody trying to get out of their houses and go back out and go eat and go do, entertainment and all those types of things. I mean, we were all spending money like crazy because we just were happy to be out of our house.
Yeah, I don't quite remember the exact term that people use, but it's like the spending rage effect, or the rebellious, spending of being told you can't do anything, and now you're, I mean, you go look at airports today and they're packed still. I mean, we're
Exactly.
still, we're still, despite the inflation we've been given to us over the last few years, it really just hasn't slowed down our ability to spend, which has been, from an economic standpoint, that's good. I mean, in the sense, it's kind of this interesting cycle that the economy stays good, it means income stays strong, it means consumers can spend, which means the economy stays good, which means income stays strong. So there's this kind of cyclical, until something breaks it, there's a cyclical nature of that I think was amplified because of the pandemic. And goods is like, and I'm looking at a graph right now, goods over the last 5 quarters has been in a deflationary mode. That was the really one of the main pieces besides energy and food that got really hot in 2022. But goods inflation has historically been the most boring thing to watch, like paint drying. And all of a sudden, because of the supply chain disruptions and the more money going after fewer goods, the core goods became a important piece in the increase of inflation, which it's never had. And so it's now deflating, not even just going up slower, it's actually going negative. And then we're seeing some of that in like auto sales and things like that. But the more sticky stuff, which is shelter, we said rents here, but really it's shelter, owner equivalence rents. That's what has been slowly coming back down off of its highs in late, early 2023. So yeah, so the LPL kind of outlook here is the U.S. is slowly, just kind of recap, slowly moving into better balance, but it's beginning to slow. Growth is just starting to slow with real spending down in the first half of the year, driven by a decline in recreational goods. A bright spot in the macro landscape is business capital spending, which was revised up in the first quarter and getting a tailwind from a lot of the infrastructure build out for artificial intelligence, AI, and the increasing demand for utilities. Inflation in the services sectors, again, being sticky, however, it's turning a corner. Fed's beginning to see confidence that 2% mandate that they have for inflation is achievable, which is why we're hearing what we're hearing from them now. We're seeing some, impact to currencies outside of the U.S. because of this, with like the yen and the euro. The yen obviously has had other issues that it went through over the last month, but we're seeing some potential impact with the dollar as it relates to the strength versus other, developed country currencies. And then despite the headwinds, really the risk of having another great financial crisis is minimal. It doesn't mean we'll have a soft landing, but it doesn't mean that the recession we could get is a massive recession that we would get, is a deep recession that we would get. So LPL's current forecast, they actually upgraded it from when this came out already. So it was 1.8, which is on the top right there. They've increased it to 1.9%, but that's just saying that GDP is slowing, and that it'll be a moderate growth, much like probably what we saw between 2010, 2011 through 2019. Unemployment will most undoubtedly be higher than 4. I mean, right now it's at 4.3. So this is, again, old information. We're at 4.3%. Could continue to see that stabilize or increase slightly as labor participation has been something that's changed in the last few months. Since this report, inflation numbers have again continued to slow and go down. So things are looking good economically, but we're not out of the woods. And so we want to just maintain a cautious optimism looking forward to what we see with how the market and the economy plays out. And it's going to have to do a lot with jobs. So as we get more jobs numbers, I don't think the market's ever reacted to a revision in jobs number like it reacted, last week, to a revision in jobs, which was a preliminary revision. It wasn't even the final. So it's just showing
significant reaction.
Yeah. Things we didn't think we had to watch until the market told us this is important to us. And so, it's just saying that it is important to know that companies can maintain employment, that consumers can maintain good wage, allowing them to continue to spend through this economy. Okay, I think we beat up the economy enough. Let's turn to stocks. So the outlook is pretty consistent, honestly, with the outlook for the economy. in that we see risks ahead, but we don't see imminent threats to portfolios long term. There's a risks that, a lot of the good news might already be priced in, and so there's some caution as to how investors could allocate their stock positions. I think the way we say it is bad news is now again bad news, where when we were trying to get the Fed to slow down their rate cuts, rate hikes, or start their rate cuts, bad news was good news because we wanted them to start those cutting processes. But we're back into this, bad news is bad news. And so as stocks have been positioned pretty high in valuation, we'll talk about what it's going to turn to is for prices to stay up, we have to see earnings prove that we're not overvalued. And that comes more slowly than some investors may like. So we should see some more volatility in the remainder part of the year, especially when it's, around any geopolitical risks that could play out. Obviously, the political environment in the US with the elections, not so much on the inflationary front anymore, but maybe how the Fed signals their rate cutting cycle. If they are doing it and they feel calm, I think the markets will take that in stride. If the cuts are coming with an urgency behind them, I don't think the markets would respond as well. So we do look at this as if volatility happens in the short term, it's really more of an opportunistic moment in the market than it is a pull money out of the market to save our portfolios. So it's what we would call buy the dip opportunities versus sell the rallies. And that's just indicative of where we see the economy at and what our baseline projection is for that. If you look back at, we've had a run since 2022, middle of October basically of 2022 is with the bottom of the previous bear market, which means it was the beginning of our next bull market. And if you kind of look at what bull markets have done on average in their first 2 years, on average, you get about a 60% growth over the first 2 years of a rotating market into a bull market. There are a few skewed outliers that if we took out would put probably that number closer to 53%, which is really close to where we're at right now, and we're not even 2 years in. So we're really on schedule, and so the additional gains start to become harder after that first 2 years of recovery. And so again, just back to the same point of valuations aren't trying to recover. Its earnings are trying to solidify our values, and that can just become a more volatile time in the market when we can get alternating views of how earnings is going each time we have a quarterly earnings reports. And if we think of it from like the Fed and how does the Fed bring in potential market volatility, a lot of people may kind of find it surprising that typically good markets happen during the pause, not necessarily the cut. It's like the market anticipates and wants the cut, and as soon as the cut happens, historically the markets have been on a more volatile or downward trend, very short term. But during the pause is when you get a lot of good markets, as you can see here. And so, we're right on course. I mean, if truly we're pausing, our pause ends next month. We'll kind of finish that out. We don't have the viewpoint that because the Fed cuts this time, that the markets will react, the stock market specifically will react negatively according to history. Because a lot of times, if you go back and look at why the Fed cuts rates, a lot of times they're cutting rates because they see economic conditions getting worse or contraction happening in the economy, and it's causing them to respond to bad economic conditions. There's only been a few times in the past where when they're cutting rates, it's not because of that. It's because the economy is sluggish and we're just at too high of rates, and we need to normalize those rates back down. And so we don't have enough data points to probably look at a trend of how the market reacts to that. But what we don't think is that the reasons the market usually has an initial decline when rates cut is, we don't think those reasons are prevalent today. And so, that, we'll see volatility, but it doesn't necessarily mean that the volatility ends negatively for us this year. Last December, corporate America had just emerged from an earnings recession. And, now, despite sizable drags from specific stocks in, say, healthcare and some natural resources stocks, earnings growth is accelerating and is at the end of Q2, so we just finished earnings cycle, it posted a very strong double-digit year-over-year growth rate. And you take out, again, a few company outliers that had specific issues with them. I mean, we were at about a 13% year-over-year increase in earnings. So because valuations are elevated, earnings has to have that kind of result for us to not really see any volatility. And if earnings is doing its part, then we believe valuations could stabilize. And so that's why it's just going to become data dependent on what earnings come out and how they look. We get a big one tomorrow. I don't know if I'm able to say specific names of stocks in these. We've never really done that. But it's a really big company that became really big in the last 5 years and is part of the AI movement. I'll just say it that way. And their earnings are coming out tomorrow. And I think that, again, is something that now is going to put a lot more pressure on earnings reports like that than it has in the past because we're at with valuations. LPL, so they have we predict, as LPL Research has a prediction of what they expect the forecast for earnings to be for the S&P 500, which is generally the U.S. stock market. For the end of this year, end of next year, currently they're sitting at $240 and $260. So if any of you more detail-oriented people who like to track that stuff, that is where they're at. I was looking at JP Morgan's was a little higher at like 242, 43-ish, 270, almost 9, I think almost 280 for 2025. So there's some disparity on how much will our stocks earn through the remainder of this year and also through next year. But that growth is going to be very connected to what kind of revenue increases we're seeing from this space in the market that's really driven up a lot of the market returns over the last year and a half, which is in this artificial intelligence space, this generative AI infrastructure built out that's happening. So what does it mean? Well, it means that if investors get spooked by the economy, jobs, the Fed, geopolitics, elections, we're really kind of primed right now to experience some volatility. We don't think that means that we're headed for the next big bear market, which is then predicting another recession. We don't see the data for that, but we think it's good to have volatility in the markets. A year or a 6-month period with zero volatility, it puts the wrong perspective on what we're doing as stock investors when we're investing in the stock market. Having a little bit of volatility like we had in April, like we had in July, it's like pinching yourself and making sure you feel pain so that you remember you're still alive. Like this is a market that's dynamic, and making sure that we respect that dynamic is important as you invest for the long term. So just another slide on valuation, just to fully hone in that we think valuations are very full. This is actually comparing valuations for the stock market with valuations from the bond market. And it's I wouldn't say it's a very all-inclusive way of looking at valuation, but it's a perspective that I think is important. If you look at a stock that's producing an earnings, that's money that either you're getting as a dividend, or that you're getting through a buyback, or you're getting through just earnings growing the price of that position. In the bond market, you primarily make money off of, we'll show a slide here later, make money off of the income, the coupon, the interest that you're getting from it. And so if you compare how much are we earning on a stock as it relates to earnings versus how much is a bond paying in income, you get this what they call equity risk premium. And what this graph is just saying is that stocks would be technically considered overvalued if it goes underneath that average line or goes underneath that solid line. And so I don't think that you move money from the stock market to the bond market because of a chart like this. But I think that what this is saying as the stock market is not a space we want to potentially be super overweighted in. So if you run a portfolio for yourself of, say, 60% stock, 40% bond, now's not the time necessarily to be jumping into an 80% stock position or a 70% stock position, but just stay neutral with that position you have in the stock market. And that's more or less what this slide is representing and saying. So moving on to bonds. Bonds have been highly correlated to the Fed policy. As we move closer to the elections, most likely the fixed income markets should see some short-term volatility as it tries to price in each candidate's policies and on tariffs and tax reform and some of the things that can have a direct impact to profitability and margins. However, we believe that the long-term movement in the Treasury yield curve, which affects all the rest of the bond market, will have more correlation to how the Fed's cutting cycle, like where they end up, and then also Treasury supply, how the amount of refinance and new debt that we have to have that hit the market over the next few years. And that'll be what we believe is a very important piece of how the bond market behaves over the coming years. Current market pricing suggests the Fed will only take the Fed funds rate back to around 3 to 4%. I know it's a very wide range, but somewhere in the 3 to 4% before stopping its rate cutting campaign. Absent an economy that slows more than expected, that range of the Fed funds rate will keep longer term maturity yields from falling drastically from their current levels. And as we've seen this year, the market pricing for the Fed's reaction has been volatile, and this rate is no exception. So that said, we still expect the 10-year Treasury, which I believe is a very important predictor of how the rest of the market behaves. But that 10-year Treasury yield would end still in that 3 3/4 to 4 1/4 range, and that's based upon an economy that has been better than expected, inflation pressures nearing the Fed target, and a supply of treasuries that we see needed in the market today. This is good for bond investors. So keeping the 10-year Treasury around 3 to 4% allows for a more robust fixed income portfolio. You buy fixed income for two primary reasons. You buy fixed income to offset stock markets in a volatile, negative moving stock market. And you buy fixed income for a safe way to make money. Those are kind of your two primary reasons people like fixed income. And the really big important piece of fixed income is the second word, the income. The income tends to be the most important part of how you make money in a long-term normal economic cycle and environment. So just as like an understanding of how important the income piece is, as a bond investor, again, remember what your total return is made up of. Total return in general is made up of a few components: the income, the change in price, and then if it's a non-US based security or instrument, you'd have to take into account currency exchange. But primarily the price and income are the two pieces that make up your total return. So you buy a stock, for example, and total returns are predicated on if that price will go up or down. Maybe a little bit of income can aid that, but your total return a lot of times over a long period of time is heavily dependent on the change in price and that appreciation that you're expecting. For bonds, it's completely different. For bonds, most of the time, they're bought at or near around where they're going to mature when they end up maturing. And your return component is driven sometimes entirely, if not mostly, by how much that bond is paying you. And since if you go back and since inception, look at the Bloomberg Bond Index, which you see on the screen, most of it, it's about 90% of its return came from the income component, not from the price and the value of that bond appreciating. So it's a good time to look at bonds as a stable piece of your portfolio, because if truly the 10-year treasury is going to stay in a range at 3 to 4%, that means we're going to be able to make money and income off of our bond portfolio better than we have since rates have virtually been at zero. And if you look at some of the swings that have happened in this time frame on the chart, a lot of that was from when we had high rates and we were bringing them down. And we're not going to have that same elongated cycle of going from high rates down to low rates, but we are in a heightened rate environment. And so where you go from here, if anything, it just stabilizes the fact that bonds will be able to use that income for the majority of your total return. So having income 3 to 4% is positive. If we get into a situation where the economy is contracting, or we see a scare in economic growth, and we see the stock market react to that, we do think bonds are bonds again. So bonds will be that part of the portfolio that are the yin to the yang. And that's going to be an important piece for any client who is looking for a more risk-adjusted portfolio. So as we move closer to the Fed rate cutting cycle, slowing economy, which puts downward pressure on long-term bond income, we just want to realize that the market is not dead here. Bonds will be bonds. I think we had this narrative that happened in 2022 when the bonds were reacting to interest rates going up, that bonds aren't bonds anymore. The 60-40 portfolio is dead. We believe it's not. We don't think bonds have been a great place to reward investors over the last 5 years, but we do believe that now, more than 5 years ago, bonds are a piece of the portfolio that will create risk-adjusted return. And right now, I think one of the issues with that is there's optionality right now. And right now, what you're getting with bonds today and what we would foresee you getting with bonds in the next 5 years is not going to be the same thing as what you're getting with cash today and what you would be getting with cash in the next 5 years. While current yields for bonds and cash are similar, bonds offer portfolio protection and potential price appreciation if an unexpected event occurs that would negatively impact the economy that you just don't get with cash. Additionally, over the past 40 years, bonds have averaged a 6.5 annual return, about 1.5 times the 4% return of cash. Bonds have also been consistent outperformers from this chart in the 434 months from 1986 to 2022. Bonds had a better 5-year return in all but 11 periods, which is like a 97% success rate. You being better held in bonds for 5 years than in cash. In the few instances where cash did better, it only outperformed by a marginal amount. So with cash rates likely to fall as the Fed cuts rates, bonds have simply just done a better job than cash at helping investors grow their assets over the long term. And we are talking from this moment in time. So it can be really easy for investors, and I think even advisors who manage money, to fall into the trap of seeing cash as, well, man, I'm making 5%, I'm making 4.5% on those treasuries I'm buying or in that money market account. I don't think it's a long period of time, call it 3 to 6 months, where cash goes from making you equivalent to what bonds can make you to not being able to keep up with the bond market as far as an income. And for people who rely on that income for retirement or rely on that income for stability in a portfolio, it's a trap we don't want people to get into, that cash feels so good right now that we forget to lock in those rates by, going into a more long-term bond portfolio that's greater than, cash, which is a zero duration or zero time to maturity. So a little technical on some of that stuff, but I think at the end of the day, when we talk about bonds, what we're talking about is they're back to what they were intended to be for investors, and don't get too caught up in the trap of staying in cash for too long, as those rates will start coming down as soon as next month. All right, so just a couple slides on the political and just politics in general, how markets respond. These are interesting times when we are meeting with our clients, and as I'm sure people are having conversations around the dinner table of how our wealth is going to be affected by this or that, candidate or their policies. And it's always a good reminder to bring back to how markets have performed historically over different mixes of government. And so the best way just to frame that perspective is to look at the difference between the political power that be and the market returns over history. And we've shown something similar to this in the past. So this, for anyone who's been on these calls over the years, this isn't a surprising statistic, but it's still relevant to talk about as we continue to get into new election cycles. The 2024 U.S. presidential election will take center stage over these coming months. And as Americans are preparing to cast ballots, polls will point to tight races, and then this person's ahead and that person's ahead. We've found that polling obviously does not fully dictate what real life will be. And something new that I didn't know that my wife actually texted me this morning was that you can now apparently bet on political races. I will be interested to see if pollings and betting spreads are the same. That'll be an interesting thing to look at. But the reality is there's a lot of hype built up into who is going to take the Oval Office after the elections and starting in 2025. And while we don't know who's going to win, the market has had a pretty impressive track record. And since 1928, whenever the S&P 500 is positive, during the 3 months leading up to an election, you see usually the incumbent party. Now the incumbent party is different this year, remain in control, but those can be wrong, and so we don't take a lot of stock in how the market or how anything is predicting what the results are going to be. But the reality is, if we just look at how the market has performed over different splits, what you can see here is the market is actually very strong, no matter who's the president, when there's a split Congress. And we just go back to that is a message of accountability, that the market likes accountability. They like not having one full agenda on stage, because that creates uncertainty, and the market does not like uncertainty. But another thing to point out here is that all of these annual price return averages are positive. And so the market can make money in any elected mix. And I think the danger is to invest your money in and out of the market based off of a political point of view, because as much as these presidents like to get up there and say, this is the economy that I handed off to the next the next seat, or this is what I received from my past Congress and past president as an economy, and look what they did. They give themselves way too much credit for what the economy is doing and how the markets are performing with who is in control. The reality is there is an effect on policy on the markets. We can't say there's not, but it is not as highly correlated, especially throwing different mixes of political parties in the mix. It's not highly correlated to saying that one party will create a positive stock market and the other one will create a negative stock market. And so it's just a good reminder to keep our political views. Sometimes you have to be apolitical when you're making investment decisions, because just so much of what happens in the portfolio has very little to do with what's happening in the policy realm. And so this is just another slide that helps with that. And then this is kind of this final slide is really it's kind of obvious based off the last slide, but if you were just to invest in one or the other's, parties, a Democrat or a Republican's presidency versus just stay invested, I mean, there's just this huge difference between being out of the market and being in the market. And while I don't know if this is very helpful, I think it just reminds and reinforces that investing based off your political standpoint can be dangerous. And so we just say, create caution when you're making decisions like that, because they can sometimes do the exact opposite of what we think.
Brian, I might add, and I think your points here are spot on. There's a timing effect as well. I mean, much like the Federal Reserve's interest rate changes, there's usually an immediate emotional reaction, but the actual economic outcomes of rate changes take months, to percolate through the system. I mean, we talked about that earlier. I mean, looking at the service sectors and things like that earlier in the presentation. The presidential policies, and again, the blended, the blended presidential policies, again, because of split Congress, those have the same timing delays. It often takes 6 months to a year or more before a policy actually begins to have an impact on the economy. So and we tend to be, as individuals, sort of immediate investors. We want to see immediate results. If I buy a stock today, I want to see it go up tomorrow, and the market just doesn't really reward us quite that way all the time.
Yeah, no, I agree, and I think a big point in this big change we're about to have with the Fed turning to a cutting cycle is that it does take a while for the economic data. We're not going to get in September. So let's say the Fed cuts a 25 basis point cut. In October, when we're starting to get September's economic data, we're not going to see the results of that yet. And so if we are data dependent, that data, it takes time for even a decision to create the data. And like what you're saying, you can overreact quickly to what you see immediately following a decision and say, oh, well, look, that was a bad idea, or that was a good idea. So it is a dangerous game to play. I think the longer you look out in markets, the longer term trends you can find, those will be more accurate than the short term trends that you're trying to guess. And we would consider short term trading as timing the market in a lot of cases when you're making decisions like this. And that's just a dangerous game to play. Stick to the long term objective and stick to your long term plan. So, and I know we're not done with the slides quite yet, but one thing we always like to say is your investment allocation and decision making in your investment portfolio should be very correlated and purposeful to what your individual plan is for what you're wanting that money to do for you. And so, seeing a client who just put all their money in cash in early 2023, who's young, who has no business being in cash but was afraid of the market, has a negative effect to that client's plan. Versus someone who realized, hey, I'm in this for the long haul. I don't know what's going to happen. I'm a little nervous right now, but I'm going to keep my portfolio invested for the long term, and then really having that, be able to pay off even sometimes in the short term. So it's important to maintain not only perspective on your investment objective, but make sure your investment objectives are representing what your long-term plan is to do with that money. Good point. So this is the kind of the last thing. We always like to close out with Our research team puts out what's called a global portfolio strategy report every month. Just think of it as GPS, where we're at in the economy, what they believe they're overweight on in their tactical and strategic allocations, the committee they have for that, and where they're underweight or where they're neutral. And it's just a good kind of practical thing you can see of where our research team is every month. If you ever want to see a copy of that report in a given month, these are client approved reports that we can send. So we're happy to email out. I don't think you can get on an email automatic chain that gets these, but if you ever are curious where LPL's point of view is in any of these, please reach out. We'd be happy to send that to you. But from an asset class standpoint, the main takeaway is that LPL is neutral on equities, with a bias to being in the bond market versus holding cash. So that reinforces really what we said today, both in the stock market part of the presentation, with valuations being a little frothy, and in the bond market part of the presentation, in that we can get stuck in this cash trap, and it'd be better to begin to push into the fixed income market more than being cash. Additionally, there's a negative bias towards inside the stock market asset classes. There's still a negative bias towards emerging markets. As that class continues to show weakness in earnings, it obviously has elevated geopolitical risks in specifically Asia and the Middle East, and there's just a lack of technical relative strength. Political uncertainty remains high in Mexico, and the long-term outlook for India is really the one area that remains positive, with a potential boost coming from the Fed rate cuts. So what I could say is our team here at AGH, in our managed models that we have that are broad-based, we are also in that same time perspective. We have a 0 weighting right now in emerging markets, knowing there's other areas to take risk in that doesn't have as many risks, we believe, but it could continue to give us reward. In the fixed income classes, there's currently a strong underweight to investment grade corporate bonds, just as the optionality of the less credit sensitive markets can lead to similar returns. So we don't need to take risk to get the income we need, and we don't need to be in cash, but we can have treasuries or mortgage-backed securities, preferred securities, other things that are getting us income, and in some cases at a less sensitivity to their credit worthiness of that underlying asset. And so that's where they're at now. Although I will say fundamentals are very strong in the investment grade corporate bond, so it's not like owning a high AA company's bond is a bad idea. It's just right now there's optionality, and so they're currently underweight that. From a sector analysis, looking at the stock market, LPL remains constructive and overweight on industrials, communication services, and energy, negative on healthcare, real estate, and consumer discretionary. All in all, LPL has a slight preference towards the rotation away from technology to more defensive sectors, as it pertains to their view of the short-term potential for volatility. But again, they're not so far negative on a sector that we would take it completely out of a portfolio. So again, these are available with more detail and narrative around these little charts in a report that's put out monthly. Just please let us know if that's something that you would be interested in. So I just want to thank you for your time today. Hope that it's been informative and a value-adding presentation. We do realize that as we, again, enter into this cutting cycle with the Fed, we're entering in a new phase in our economic cycle, and we believe the Fed is cutting for the right reasons, which is a change from many past rate cutting cycles, and we believe that the markets have to prove their valuations through earnings and the ability to grow revenues. And again, please remember that when you invest, just maintain that long-term time horizon that is critical to meet your long-term objectives, and always relate it back to your financial plan. As we swing through these disclosures, just want to make sure again that you're aware that Brad and I are available by email or phone call following this presentation for any additional discussions. And I'm going to turn it back to Brad for some closing comments. Brad?
Thanks, Brian. Nice job today. I appreciate all the good information. And I'm just going to reiterate, again, thank you all for attending today. I hope you found the information helpful and timely. As Brian said, there are still a lot of question marks that are out there in the economic data we're receiving. But as we continue to go through those, we'll continue to update you. You should, if you are interested, we do send out periodic emails that give, sometimes they're coming out weekly or every other week on just outlooks on where we think things are changing in the market. If you're interested in getting those, please let us know. Again, reach out to Brian or I, and we can get you subscribed to that. And if you'd like a copy of the slides in the book that we went through today, just again, reach out to us and let us know. Otherwise, thank you all very much. Appreciate your time today, and have a great balance of your week. Take care.